Banks are primarily in the business of lending money to individuals, businesses, and other entities. Again, this money comes from the pooled deposits of other individuals, businesses, and entities. In essence, when a bank makes a loan to someone else, it's borrowing from its depositors. Banks also can borrow money from other banks and the Federal Reserve. Interbank lending, meaning loans between banks, usually happens on a short-term basis. These loans serve an important purpose: to ensure that banks can meet the Federal Reserve's liquidity requirements. These requirements help to ensure that banks have enough assets available to manage withdrawal demand. The Federal Reserve can issue loans to banks and other financial institutions to help address temporary problems in obtaining funding. Banks can pursue this option if they can't get the loans they need through the interbank lending market. Compared to those loans, the Federal Reserve lends money to banks at a higher interest rate. Aside from borrowing and lending, banks also play a role in the transmission of monetary policy. This ties into how the Federal Reserve manages monetary policy in relation to economic shifts. When the Fed changes monetary policy, it's usually related to one of three things: curbing or encouraging economic growth, managing inflation, or reacting to changing unemployment rates. For example, the Federal Reserve can cut interest rates to encourage consumer borrowing and spur economic growth. Banks, as a result, may reduce the interest rates they charge on loans. In theory, this prompts more people to borrow, which bolsters the economy. The trade-off is that rate cuts aren't limited to loans. Banks also can reduce the rates they pay to savers. Likewise, when the Federal Reserve raises rates, banks can follow suit and increase the rates they charge on loans or offer on deposit accounts. This makes borrowing more expensive, but it also encourages people to save money since they can earn a higher interest rate. Types of bank accounts. Consumers usually view banks as places to keep money or as places to go to borrow money. The types of accounts you can have with a bank may include checking accounts, savings accounts, certificate of deposit accounts, money market accounts, credit cards, auto loans, mortgage loans, student loans. A checking account allows you to deposit money, pay bills, and make purchases by writing checks or using your debit card. Processing transactions is another important job for banks. When you swipe your debit card or use your ATM card to make a withdrawal, that transaction has to be approved by your bank before it can be processed. Banks also make it possible to make electronic automated clearinghouse transfers or wire transfers between individuals, businesses, and financial institutions. Savings accounts, CD accounts, and money market accounts are all options for saving money. These accounts can pay interest to savers, though they each work differently. Savings accounts, for example, allow you to set aside money you don't need to spend while keeping it accessible. Depending on the bank, you may be able to access your money at a branch, ATM, or online. CD accounts are time deposits that pay interest over a set period. Common CD terms range from 30 days to 60 months, but it's possible to find CDs with terms as long as 10 or 20 years. Generally, the longer the term, the higher the interest rate you can earn. Banks can charge a penalty for withdrawing money from a CD before it reaches its maturity date. Money market accounts can earn interest like a savings account but give you withdrawal options similar to a checking account. For example, you may be able to write checks, make ATM withdrawals, or make purchases using a debit card. Banks can, however, limit the number of withdrawals you can make from savings accounts and money market accounts each month.